Hello again, everyone. It's 10 o'clock in the morning Chicago time on Tuesday, October 18th, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially through the end of this year. Let's begin. Number 1, the S&P 500 testing formidable major support. Here we have the S&P 500 chart going back to 2020. So just above where my photo is here, this is the low from March of 2020, which was the COVID low. January 4th high of this year, and this is where we are right now. 2 really important levels to watch. The first one is the September 2020 high, benchmark high at 35.88. We've been testing this really since June. You can see the June 17th low here was just above that level. We came back up, tested the 200-day moving average, which many people look at is a back of the envelope indication of where the major trend is. Stopped on a dime. We had the CPI number right in here. That was that really violent day that we had about a week after we hit these highs here in the middle of August. Turned the market down, and look where we stopped again. We actually got through 35.88 a little bit, but not very long and not by very much. And now we're moving back higher just over the past few days or so. The other important level to watch here is 33.94. I actually think this is the more important of the 2 levels, but we need to get there first. But should we break down and make new lows here, I'm going to be looking hard at 33.94. This is the February 2020 benchmark low, and again, another logical place for the market to find its footing and maybe start a rally here that could last 1 to several quarters. Primary tactical resistance, which in our language means that's what has to hold in order to keep the minor trend intact, is 5% above the market at 39.16. You could see it here. It's the blue 50-day moving average. Major resistance is 11.1% up above the market right now at 41.51. That's the current location of the 200-day moving average. Number 2, market internals. The Asbury 6 remains negative, but maybe turning. Those who know me either through StockCharts or through some of the other interviews and podcasts that I do around the internet know that the Asbury 6 is our internal indicator that helps us to determine what the day-to-day health of the stock market is. I built this maybe 5, 6, 7 years ago. I kept it internal for a while, and I built it for my own use because the market of today is not like the market 10 years ago. It's much more volatile day to day. You see this. The market's up 50 today, it's down 40 overnight, and it's up 70 the next day. Very, very easy for investors to get kind of sucked in to buying a rally that doesn't hold, only last a day or two, or getting scared out of a good long position only to have the market turn up hard over the next 2-3 days, and now you've got to buy the position back at a higher price. So I built this to give me kind of a lie detector test on what's really going on in the market. So what we look at here are 6 different indicators. We back tested all of my favorite tactical indicators throughout my career. I've been doing this since the 80s when I was back on the trading floor of the Chicago Mercantile Exchange. So we put 6 indicators together that work very good in the respect that if 1 or 2 of those indicators are giving you a false signal, the other 4 will pick it up. So you can see we've got the rate of change here, which is the only one, by the way, that has to do directly with the price of the S&P 500. And we did it on purpose. So we're not chasing the tail of the S&P 500, and we're looking at more I don't want to say sturdy indicators, but indicators that can't be influenced by the day-to-day gyrations of the S&P 500, which is largely due to algorithmic trading, computers trading with each other. So we have the relative performance between stocks and high yield bonds. We have investor asset flows, corporate bond spreads, trading volume, and market breadth. You could see right now 4 are red, 2 are green. There's been almost all red on this particular model since the middle of August. Starting to turn a little bit. We have 2 of the 6 investor asset flows and corporate bond spreads starting to turn slightly positive here. What's the line of demarcation? It's when we get 4 green. If we get back to 4 positive or 4 green constituents, that's going to indicate that the internal health of the market has now gotten better, and we should now be looking for buying opportunities. We aren't there yet. The other nuance that I wanted to point out about the Asbury 6, which really makes it a good indicator, aside from just telling you how healthy the market is day to day, is when we see the signals rapidly changing from red, which is negative, to green, which is bullish, positive. When you see this flickering back and forth, like we had this from the beginning of December through the middle of January, where it was red, green, in a very tight range. This is called blinking. That tells us that the market is probably at an inflection point, and we should be looking at this entire area up here, which was the end of December, the middle of December through the middle of January, as a probable turning point for the market, a probable top. That's exactly what happened, and it gave us this big move down that we've had all this year. You see more blinking down here. It was smaller. There were only 3 blinks, so to speak. We went up, down, and up here in the early to middle part of July. This was right after we made the June bottom, the mid-June bottom, and that took us all the way up to those August highs. And what do we see? We saw more blinking up here. From August 23rd to August 26th, we had a really quick down, up, down. That told me that this was probably another significant high, and we should pay attention to it. So we don't have any blinking right now, obviously. You could see the A6 has been negative since September the 13th, but we will be looking for blinking to indicate that this might be a tangible bottom down here and holding on to those support levels that we saw in the previous slide. Number 3, volatility. VIX is at a tactical decision point. So what we have here is the S&P 500 going back to June of this year up top. This is daily. And then we've got the VIX down here in blue, along with its 21-day moving average. So the VIX moved underneath its 21-day moving average on July 1st, stayed there through August 9th. That's this period here that I'm circling up top. Now, since August the 22nd through the present, it's been up above the 21-day moving average, and that gave us all of this. So where are we now? We're sitting right on the 21-day moving average. It's at 30.77. It's going to move a little bit every day, but let's just call it 31. If we start seeing the VIX move below 31 and staying there, not going down under it during the day and popping back up by the close, but a couple of 2-3 days where we're under 31, that's going to suggest to me that the market has become calm enough to sustain some kind of a rally that's going to last more than just 1 or 2 days, which has really been the case for the past couple of months. We've had some hard rallies, but they haven't stuck. So this is a really important one to watch over the next several weeks until I'm with you again, probably about a month from now or whenever that might be. So keep an eye on VIX 31. Under it, sustainably, is going to suggest to me that we're a little closer to making that bottom. So let's talk about this possible bottom in slide 4. Investor sentiment. 2 bearish market analysts suggest a bottom is near. So what we have here is the S&P 500 up top. This is a weekly chart. This goes back to 2010. Down underneath is the investors' intelligence data. There's different parts of the data. There's different ways to look at the data. This is the percentage of market bears. Actually, Asbury Research is one of the inputs for the II data. They look at a lot of different independent investment advisors like Asbury Research, and they try to get a consensus on how the market's feeling, how professionals are feeling in the marketplace. So look where we are here. We're up at a most bearish extreme. The kind of the band that goes through the middle that catches all these tops is from 35% to 39%. You can see that we're pulling back from that. We hit that in June. That was a bottom for us. We're pulling back from another extreme in middle of September. September 16th actually was the peak there. And then as we go back across the chart, look what we have for March 2020. That was a COVID low, bottom. December 2018, that was another important low. February 2016, another one. October 2011, this was a big spike kind of outside this recent range of highs. This is the highest for the series here that I'm showing. And then we had another one August 2010. So this doesn't tell me to buy today. This is not a tactical indicator. It's a strategic indication of where another market bottom might be. So this is important to pay attention to, and why I wanted to lead off this Your Daily 5 is showing you where those support levels are. So we've got this indicator telling us we're near a bottom. It's better if you have a level to lean on. Now, there's two really important levels that we showed in slide 1 in the S&P 500. So number 5, market breadth, another sign of a bottom. Here we've got the S&P 500. This is daily, and this goes back to 2004, so almost 20 years of data. This is the percentage of NYSE composite stocks that are trading above their 200-day moving average. We're at a low right now of under 10. If we go back across this chart, I've marked off the other times that we were under 10. March of 2020, the COVID low again. December of 2018, we talked about that on the previous chart. Jan of 2016, August of 2011, and November of 2008. This doesn't tell us to buy today. Again, this is strategic. This tells us that we're in the neighborhood, but we're not in the driveway yet. What tells us that we're in the driveway is when we get the Asbury 6 going back to green, going back to positive. When we get our other tactical indicator, the correction protection model, or CPM, when that turns back to risk on. You could learn about these a little bit more if you go to our website, visit the website, asburyresearch.com. But those are the tactical indicators that we need to tell us that there might indeed be a bottom here. We're not there yet. So Asbury 6 back to green. The VIX back down under 31 and stay there. There's some other tactical tools we're looking at. So we're close, but we're not there yet. I think this is the time to stay on your toes. Seasonally, October is typically the weakest. The last week of October, which we're approaching here, is the weakest week historically, seasonally, in the S&P 500, going all the way back to 1957. So that's another indication. Maybe once we get out of October and get into November, we're going to get some seasonal tailwinds in our favor. So keep your eye on the VIX. Keep your eye on short-term tacticals. I think there may be a very good opportunity to buy the market here over the next month or so. So there you have it. If you like our approach to markets and investing, I invite you to visit our website, again, asburyresearch.com, to get more information about us and some of these technical tools that we've been talking about here today. If you'd like to see more videos like this one, you can visit the Asbury Research channel on YouTube and subscribe there. Thanks for watching, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.